Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Miami at the Exchange ETF Conference, and joining me for this segment, we have Michael Lane, who's the head of iShares U.S. Wealth Advisor over at BlackRock. We're going to take a look at the challenges and opportunities facing advisors and investors and how ETFs can help solve them. It is great to have you with us, Michael. Welcome to Trade Talks.
It's great to be back, Jill.
What's the focus on when you're looking to solve these problems?
So with advisors, for a long time, we spent very little time talking about ETFs and fixed income because of the fact that the yields were so low that most of the people were starting to talk more about how they could generate more yield by giving up liquidity, taking credit risk. But now with what's happened with rates, we're joking all the time that bonds are back, yields are up, and that's all everybody wants to talk about now is what's the right way to structure the fixed income part of a portfolio versus 2 years ago, every focus was on the equity side of the portfolio.
Right, so what is BlackRock doing to help solve these problems?
So there's multiple, I would say, problems that advisors need to solve for. One is they have to make a decision about the credit and duration that they want exposed to. So if they want to take credit risk right now, you can generate upwards of 7.5 to 7 3/4 yield if you wanted to buy things like USHY or HYG, high yielding, more credit sensitive type ETFs. If you want to be on the short end of the curve, which is where I tend to stay, I'm more of a short end, high quality guy, but if you wanted to be on the short end, you can now generate yields almost 5% with duration sensitivity in the fraction, like 33, 34 basis points of duration. So your interest rate sensitivity is very low, but you're able to generate almost 5% in very conservative treasuries. So there's a lot of opportunity, I'd say, for people, the advisors and consumers, investors direct, to make decisions about where they're going to fall on the duration curve and the credit curve, but now it's not where you're getting single digits anymore. Now we're in the 4, 5, 7% range of yields.
And that really is a remarkable thing about having it in the ETF wrapper. It makes it so much easier for the advisor to structure because it is, to your point earlier, it's more complex trying to build a fixed income portfolio than, let's say, equities as an example, because there's so many moving parts.
There's moving parts and liquidity comes into play, where a lot of people don't talk much about liquidity. And in the institutional space, if you were to interview, which we did, we surveyed institutions about how they select ETFs, particularly in the fixed income space. And what we found was the number one thing they looked at was the liquidity of the ETF. Because big trades, you want to make sure that you're not going to push the and expose yourself to a lot of trading costs. And that's one of the things that advisors have third or fourth on their list. But as you've had this confluence of consolidation in the RIA space, particularly where they're being bought up and consolidated, you have that with this increased use of models. You're going to need more liquidity in your fixed income portfolio. So we're seeing a lot more discussion, and we should see a lot more discussion around the liquidity aspect of ETFs and fixed income. Whereas we always saw that in the equity side, people didn't talk about it much in fixed, but now we need to.
So what's the market outlook for 2023? Still some uncertainty, some volatility. Is the market getting ahead of itself when it comes to the Fed?
So interestingly, I was just reading a report internally at BlackRock where there is a sense of market pricing in rate cuts before the end of the year. We are confident that that's going to happen. And you're seeing yields tick up a little bit today, and so we're taking more of a stance that you should be aware of the fact that rates could still go higher. We have a very robust jobs market still, and rates could go higher, and that's why we're helping advisors really understand the use of floating rate fixed income. So like T-flow, which is treasury floating, and just float, FLOT, which is corporates. Those will keep pace much quicker with rising yields and don't have the interest rate sensitivity, very, very low duration. So we believe that in 2023, the idea that there's going to be a rate cut before the end of the year is probably less likely, and so maybe floating rates aren't a bad place to be.
It seems as if the market's almost confused. I think the Fed has been crystal clear with telegraphing its message. I think they're highly sensitive to not making the mistakes that we saw in the 70s, which brought on inflation. And there really is no indication that they are going to change course, and it's really confusing how the equity market is digesting it, because it looks very different than what the bond market is interpreting.
It is, and that's why when people ask me where are the bright spots in equities, my response is there's no consistency. There's no answer to that. That's why we see people still, some leveraging the idea of using minimum volatility strategies, while others believe that markets are going to have an uptick in 2023, and so we're seeing, particularly because January was a good month, and so there's this exposure where we're seeing people believing that there's going to be a big run in equities. We don't have an opinion yet on that
Right.
because there's too much inconsistency we're seeing as well in the marketplace. In the fixed income space, although there's some of these pricings that the market is factoring in that we don't necessarily agree with, there is at least a belief that being short and taking advantage of these yields of 4.5% to 5% on the short end, like that's something we haven't had in a long time,
Right,
so take
right.
advantage of it.
Appreciate the insight, Michael. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.